Good morning, guys. Well, I see Caroline, it's only you at this point in time online. I presume the others will come later, or otherwise they'll listen to the recording. Let me just see, what did I want to put on? Okay. So what we're going to do today is we're going to go through an exam paper, and I've got a 2018 paper. So we're going to just basically go through and have a look at what questions they had on the paper, kind of like you can get an idea of the mark allocation between the different learning units, because you know we've got our exam learning units, which are our capital budgeting and advanced capital budgeting, and then the others that we've already been tested on. So for you guys, let me just double check, where am I? We've got today, and then we've got next week on Thursday in class. So we'll do a paper on both of these days. So we've got plenty of time to do some revision. I just want to put on screen while we're busy with this, the actual formula sheet. And I'm just going to remind you guys again right at the beginning here, please, for goodness sake, when you are doing your revision, you must print out yourselves a copy of this formula sheet. And when you're sitting at home and practicing questions, whether it's out of the textbook or whether it's past exam papers, you must work with the formula sheet, so that you're sitting there and you're simulating the conditions that you would be working under if you were in the exam room. Okay, it's very, very important, because if you're sitting and you're just working with your textbook, you've got all the formulas available to you right there, and you'll be working away, and then suddenly when you're sitting in the exam room and you don't have the textbook there, and then you suddenly realize what formula is not on the formula sheet that you need, and then you're going to be completely stuck, because without the formula, so you need to know what's on the formula sheet, but more importantly, you need to know what's not on the formula sheet, so that you yourself can prepare and memorize those items that you don't need. And then just remember, with most of these formulas that you'll be using, you can generally take one of the other formulas, obviously not so much with the standard deviation, because that's quite specific. But these ones over here, where you've got present value, bond valuation, and variable growth, remember, these are really, you're looking at the same formula, where you're taking a present value of one set of cash flows and you're adding it to the present value of another cash flow. Same thing over here. And if you have a look, remember the net present value formula that we looked at for capital budgeting is basically the same thing. It's they've got at the front, the answer is net present value equals, and then you've got the present value of the initial cash flow plus the present value of the operating cash flows. So just make sure that what I'm trying to say is work with the formulas that are on your formula sheet and just learn to adapt them. So if you've got a printout of the formula sheet, then on your formula sheet while you study, and next to these formulas here, you can write the adaptations of these ones that you need for your other work, like the formula for capital budgeting, and those ones that we did yesterday for advanced capital budgeting as well. Okay, that's very important. Okay, so what I'm going to do I'm going to share the files on another screen so that I can I don't want to share files. Sorry, we go back here. I want to share screen so that I can keep an eye on the chat. Okay, entire screen, share audio. There we go. Okay, so hopefully you can, let me go here. Oops, sorry, I was making sure I've got the right. Okay, so on that one, that screen, I can see the chat bar, and then on this one, you guys can see the paper. Okay, so can you guys see the exam paper clearly on the screen? Can you see my screen and you can read the exam paper clearly? Okay, perfect. Then I can work here. All right. Okay, so this was a 2018 paper. So let's just have a look. So your question 1 on this paper was for 40 marks, was a capital budgeting question. So let's just have a look at what the required is. So 40 marks is a nice big fat question. And what they wanted us to do, the required, and please take note of any instructions, round all calculations to the nearest rand, or if they say you use 2 decimals, then please do just exactly what they say, otherwise you can lose marks. Calculate the cash flow associated with the initial investment in the machine. So that's 4 marks for the initial cash flow. Then for 12 marks, calculate the taxable income for years 1 to 4 of the new machine. So please read carefully. That's the taxable income that we want, because we need the taxable income to then do step number 3 for 60 marks, which is then to calculate the operating after-tax cash flows for years 1 to 4 for the new machine. And then lastly, calculate the net terminal value that must be included in year 4 on disposal of the machine. So this is basically a full capital budgeting exercise, just like you have got in your textbook. So it's nice the way they've broken the question down into these 4 sections. So instead of just saying, asking the question to say, put this all in one and just say calculate the cash flow, the after-tax cash flows associated with this project, they've broken it down for you, which kind of gives you a hint as to how to do your workings. Okay. And then for 5 marks, they've added a theory part of the question, which says, in your report to management, you've indicated the company needs to pay more attention to its capital expenditure in order to maintain its competitive advantage. So describe the term capital expenditure and explain how it is to be recorded in the financial statements. So also to do with that same thing, but then a fully theoretical question. So I had done a previous calculation on the front of this paper that I see, and in this paper that we're looking at now, there were 31 marks of theory spread out amongst all the questions. So that's 17% of this paper that we're looking at now with theory questions similar to this one over here. So guys, you have to be prepared with your learning objectives for those theory questions. Please, it breaks my heart when I see students throwing those marks away because they haven't prepared theory questions for their learning objectives. Okay, they tell you in the learning objective what they're going to ask you. So just make sure that you have learned that. Sorry, I just want to put this timer on so I don't get carried away. 8:29, 10, 10, 10. Okay. Okay, so let's have a look at the info. So now you know what we've got to do. So the number 1, calculate the cash flow with the initial investment, calculate the taxable income, then calculate the operating after-tax cash flows, and calculate the net terminal value. So this is the info that they've given us about the machine. And guys, I've been drumming this into my second years, but you absolutely must take a highlighter in 1 or 2 different colors with you to the exam paper, so that when you sit in, look at the amount of data you've got to sift through here in order to do the question. And if you don't have some kind of method that you are organizing this data while you read it, then you are making your job harder. You will make mistakes, you will leave things out, and you will misread stuff. So preferably if you've got say 3 colors, you can highlight in one color what is involved in initial investment. You can highlight what you need to include for taxable income, and you're operating in a different one for terminal, so that you clearly make sure you don't leave anything out, that you highlight your percentages that you've got to work with, that you really organize all of this, and that you can't not read any single one of these lines here, because all this information you need to make sure that you get your question correct. So it says Allwind is an aluminium window company that's looking to invest in a specialized manufacturing machine, which will be used in the manufacturing process over a period of 4 years. So through reading the first draft of the project proposal presentation, you've established that the motivation for acquiring the machine is to enhance the existing level of production output in order to satisfy the projected rise in demand from the building industry. So they're just bringing in a bit of the theory there. Remember, right at the beginning of your capital budgeting chapter, you've got that section on reasons for capital investment. And they could very well have asked you a question on that related to this. Remember, you've got replacement, expansion, or renewal capex. So they could have given you a theory question to say, what type of capex investment is this, and explain what other types of investment there are and what they all entail, something to that effect, because that is also a learning objective. Okay, so just as an example of what they could also have asked you. Following information, the machine will cost 2.250 million with an additional 150 for delivery and installation costs. At the end of the project, we can sell the machine for 275. The machine will generate 675,000 net inflows before tax per annum. And that number includes the annual depreciation charge. In other words, we've deducted depreciation in order to calculate that amount, but it excludes any incremental working capital movement, and it also excludes the impact of inflation. So you need to read that carefully so that you've got the amount and you know what adjustments you need to make to that amount in your question. We'll go through it when we look at the memo. The machine is to be depreciated straight line basis over the life of the project. So make sure you know what the life of the project is, so you do that calculation correctly. Annual inflation is 10% over the life of the project. Initial working capital 220, followed by incremental annual investment of 10%, which means each year you then have to increase your working capital by another 10%. I remember marking this, and a lot of the students made a mistake where they did the 220, they increased it by 10%, and then they only increased it by 10% once. If it says annual, then that means every year. Tax rate is 28, capital gains inclusion rate is 80%, and we're using the 4-year because it's a new machine. Capital allowance 40, 20, 20, 20. Assume any calculated tax asset or liability is realized in cash at the end of the year in which it rose. So this is important, and if you've worked through any of the questions in your textbook, you'll see that, excuse me, in some of the questions, they say that your tax asset or liability is realized in the year following the year in which it arose. So that's just telling you in which year of your 4-year cash flow to include the tax payment. So here they're saying we are going to pay the tax to SARS in the same year in which that tax liability arises. So just watch out for that one, because that one, no matter how often I highlight to that students, they still get it wrong. Ignore VAT, and our cost of capital is 12%. Okay, so now let's go and have a look at the initial investment. So in your textbook, you've got these 3 different areas for relevant cash flows. That's divided. Remember, relevant cash flows, you must go through that so that you know what's relevant and what's not relevant. And then after that, in your textbook, you've got that section on the components of an investment project, which is initial, operating, and terminal. So here is our initial cash flows. So it was for 4 marks. You had to include the cost of the new machine. That was 1 mark. You had to also include the delivery and installation cost, because remember, directly attributable costs form part of the capital cost of the machine. So if you have a look just in brackets over here, this is just my workings when I was marking. Your capitalized cost of the machine would have been 2.4 million. Okay, you should remember that from accounting. Then we also would have had a cash flow out for that initial working capital requirement. So our initial cash flow out on initial investment is 2.620. So there's your 4 marks for the initial investment. Then for 12 marks, they ask for, everybody okay with that? Any questions on that, on the initial investment calculation? The most common error there is that students will leave out that delivery and installation portion. So make sure you understand that. Those are your capitalization rules from accounting. Okay, so then next we've got the taxable income. So we need to calculate the taxable income over the 4 years so that we can calculate what our cash flow for tax will be as a result of the relevant cash flows from the project. So they told us that our before tax, if we go back here, the additional net inflows before tax generated by the investment project are currently expected to be 675 per annum. So currently means right now in year 0, okay? You've got to read the language carefully. That includes the annual depreciation charge, which means we've already deducted depreciation, but it excludes any incremental working capital movement and the impact of inflation. And we know over here that inflation is going to be, where did they give it to us? So you would have highlighted this so that you don't have to waste time looking for it again. Here, 10% per annum, okay? So currently cash flows are 675, that means at year 0, and there is expected to be for in the future 10% per annum. Okay, so year 1 cash flow, 675. I don't know if you can read these notes that I've put here. So the additional net inflows, we've got to add back the depreciation to the 675 because they said that that's after depreciation, and we then add on the 10% inflation. So that's the calculation that you've got to do in order to get the net operating cash inflow that's generated by the project over those 4 years. So why are we adding back depreciation? Why are we adding back depreciation? Why are we doing that? Remember, this is a capital project, which means that in the questions information, they've given us that information about the tax allowance. Remember, you would have done this in accounting when you calculated deferred tax. You have to add back accounting depreciation so that you can subtract the capital allowance, which is the tax allowance. Yeah. So we're adding back accounting depreciation so that we can subtract the taxable capital allowance. You with me there? Okay, so here we start. So year 1. So remember, in year 0, my cash flow is 675. They said currently, which means year 0. So in order to calculate my cash flows for year 1, I'm taking 675. I'm adding back the depreciation which you have to calculate as being the capitalized value of the machine divided by 4, because it's over 4 years of the project. And then you are multiplying that by 1.10. In other words, you're adding 10% onto that to get your cash flow for year 1, 1402500. And then all you have to do for year 2, 3, and 4 is just increase that amount by 10%, because you've already deducted the depreciation. So you've got the excluding depreciation amount, and you've inflated it by 10%. Okay, so have a look at the marks. There's a method mark for year 4 and year 3. There's in year 2 they have split it into 2 half marks, and then in year 1 there's 1, 2, 3 marks for getting that initial calculation correct. So we've added back depreciation, and then in the next line we then deduct the capital allowance, which is our tax allowance, which is 40% in year 1 and then 20 in the other 3 years, and it's still on our capitalized amount of 2.4 million. And that equals our taxable income. So the only adjustment that we had to make to get to taxable income was to add back depreciation, subtract the capital allowance, and that gives us our taxable income in this particular instance. Okay. Everybody okay with that? And it says over here for the marking, to receive the method mark, which means these 2 method marks here and that mark there for years 2 to 4, for before tax net cash flow, students must have applied 10% to the previous year's figure. So that method mark is for inflating each year by that 10%. And then have a look here for your capital allowance. That was divided into 2 half marks, and there's no method marks there. But your taxable income is a method mark. But remember, you don't get this method mark if your method was not correct. Okay, any questions on this one? So you can see you've just got to be wide awake to make sure you incorporate everything they've put into the question into your calculations. Are you guys happy with the operating cash flows? Not operating cash flows, to calculate your taxable income. Okay, so then we can go on and have a look at the next section, which is then that they want to calculate the actual cash flows. Okay, so in other words, cash item, relevant items, cash flow only. Oh, okay, Tim, not to worry. We're just going through a 2018 exam paper. And we're busy working our way through the first question, which is a full question on a capital project. You'll be able to catch up there. Okay, so the first thing that we have to do before we construct our operating this table here that you're looking at on the screen, which is our cash flows, is we have to work out this line over here, which is the incremental working capital that we have to spend each year. Because remember, whatever changes happen during the life of the project related to working capital will then be included in the operating cash flow section. Remember here we've got initial working capital investment here in the initial cash flow section, but in this question they said in every single year our working capital has to increase by 10% per annum. So this workings over here is to calculate the incremental amount for each year that we have to invest in working capital. Okay. So at year 0, initially, we had to invest 220,000 in working capital. So the incremental amount, which means what is the additional amount in that particular year, is 220. We've included that in our initial cash flows already. Then 10% of the 220, that's going to increase by 10%, which means that it's going to in year 1 increased to 242. So that means we will add an extra 22,000 in year 1. The 242 will increase by 10%. So that means the difference between 242 and 262, in year 2 we add in 24,2, and then in year 3 we're increasing it by 10% again. So that means it's increasing by 26,620 in year 3. And then in year 4, at the end of the project, the full amount that we've got invested in working capital will then be released. So you've got a cash outflow related to working capital year 0, year 1, year 2, year 3, and then in year 4 we've got a net cash inflow when all of that working capital is released. And obviously it's this amount here that gets released, which is the initial working capital that's been inflated by 10% each year. Okay, it was at 10%? Initial working capital, incremental annual investment, yeah, 10%. Okay, so you need to do this workings to calculate these amounts here. So that's already in our initial workings. So we need these 4 amounts here in our operating cash flows. So here's your cash flow. So taxable income over here comes from this table over here that we have calculated, taxable income. So that's the before tax taxable income. Then we are going to calculate the amount of tax on that. And remember, in this question, they said that the tax cost or tax liability will be paid in the same year in which the tax liability arises. So my tax for year 1 must be deducted in year 1. In some of the questions, they tell you that the tax liability will be paid in the year following the year in which the liability arises. If that was the case, you would have 0 cash flow here for tax, and this tax related to year 1 would be deducted in year 2, and so on and so forth. So just you've got questions like that in your text, so just have a look. So the income after tax we've got there. Then we have to add back the capital allowance because that's a non-cash flow item. And then we have to deduct the incremental working capital movement because that is actual cash flow, and that then gives us our net actual cash flow for each of the 4 years. And then the last one wanted the terminal value for year 4. So terminal value is that we are going to sell the machine for 275,000 at the end of the 4 years of the project. So the 275,000 is less than what we initially paid for it, so that you know then there won't be any capital gain. But because the machine would have been fully depreciated by the end of the 4 years, that 275,000 will be a recoupment of previously claimed allowances. So we need to include that 275 in our taxable income. So the after-tax effects of that 275 cash inflow that we will get is then 198, because we'll have to pay 77,000 Rand tax on that 275. So the terminal value is then a net cash inflow of 198. And just while I'm talking about inflows, take note that that 198 has got no brackets around it because it's an inflow. And over here in your workings for the cash flow, if it's a cash outflow, you have to indicate that the fact that it's a cash outflow with brackets. And the incremental that you're adding back, so that's positive. And the working capital is cash outflow, that's negative. You must indicate it with brackets. You have to do that. If you don't do that, you will lose all of these marks here, these method marks. And I can promise you, I'm not going to be sitting there marking exam papers with my calculator, working out your workings to see whether you added or subtracted the amounts that you've written down there. You have to indicate negative or positive in order to get that amount. So either over here on the left-hand side, you will say less tax paid, plus capital allowance less incremental working capital. I'll accept that. Or you write brackets around everything that's negative, or to be on the safe side, you do both. But you have to indicate whether you have added it or subtracted it. Okay. Please don't lose those marks. So that, and then of the 40 marks, the 5 marks remaining is then that theory question. So just to remind you what they asked you there. So Tim, just to remind you, you can just have a look. This is they gave us all the info, and this is the questions that we've been working through. For 4 marks, they wanted the initial cash flow. 12 marks, they wanted the taxable income. And for 16 marks, they wanted the operating after tax cash flows for the project. And for 3 marks, the terminal cash flow. So that's what we worked through. And then for 5 marks, there was a theory question. Describe the term capital expenditure and explain how it must be recorded in the financial statements. So again, when you're sitting there with your highlighter reading these questions, or with your red pen or something, you're going to underline the word describe, highlight capital expenditure. You're going to circle and big circle to make sure that you know there's 2 parts to this question. You must describe the term and underline, explain how it must be recorded in the financial statements. So capital expenditure represents the payments for capital projects or investments that are expected to yield benefits. So you must just explain that capital expenditure are those expenditures that we invest in long-term assets. So benefits that we expect to gain for longer than 1 year. So that must be included somehow in your answer. And then capital expenditures are recognized in the statement of financial position. So in other words, where will they appear in our financial statements? So we can see capital expenditure in our statement of financial position in the balance sheet as in the non-current assets section. And usually it's included in the property, plant and equipment line. And then we then depreciate them over the period that the asset provides benefits to the company. So in the profit and loss section, in our comprehensive income section, we will be able to see the depreciation related to it and the carrying value of the capex item in the non-current. Anything to that effect that shows that you know what that capital expenditure is and what your journal entries are. Not so much your journal entries, but where the carrying values for accounting related to capital projects would be reflected. Okay, so that's a lovely long question. You can see it's a nice meaty 40 marks straight off the bat for your exam chapter. Anyone got any questions related to that? You guys happy with that question? There's lots of questions like that in your textbooks. So working with your textbook, you would have been fully prepared for that question. And of course, the benefit with working with your textbook is that you've got the full solutions in your textbook. Okay, so make sure that you have fully prepared with the textbook questions. Okay, so then let's have a look at the next question. So question 2 for 25 marks. Let's go and have a look at what the required is. For 11 marks, calculate the payback period. So this is also our exam chapter 6 and 7. For Jedi Flight, and advise whether Walt Limited should select Jedi Flight based on this method by giving a reason for your answer. So again, for these 11 marks, you've got to do 2 different things. Underline calculate and circle and underline advise, and then underline give a reason for your answer. So there's basically 3 things you've got to do. A calculation, you've got to give them advice, tell them whether they should or shouldn't undertake it, and then give a reason for why you chose your answer for 11 marks, and that's payback period. Then for 9 marks, calculate the internal rate of return for the project using your financial calculator. Write your inputs down in your answer book. They'll be marked individually. And Advise whether Walt Limited should select based on this method, also giving a reason for your answer. Okay. So I've noticed in the last couple of years, being 2020, and I can't remember so much for 2019, they seem to have stopped specifying whether you should use your financial calculator or not, but take note from this 2018 paper, they can ask for a specific method. Okay. And then for 5 marks for 2.3, theory question, give reasons why the director may prefer using the payback period to evaluate a project instead of using the internal rate of return. Okay, so remember what I said at the beginning, Tim, you weren't here, but this particular paper, 17% of the marks in this paper are theory marks, similar to this question, 2.3, and similar to that question for 5 marks at the end of question 1. So 31 marks in this paper is theory questions. So this is the project cash flows that they've given us. New attraction, determine whether it should be built or not. Useful life of 7 years. So here's our 7 years worth of cash flow, after which it will cost 500,000 to dismantle the ride. Please read carefully. This is the part that the students predictably left out. They tell you here that 500,000 is not included in these cash flows below, which means you must still add that 500,000 cost at the end of year 7. The company's target payback is 5.5 years. Here's our projected cash flows. Remembering that these projected cash flows do not include the 500,000 cost in year 7. And the only reason that they put that there and don't include it here is to test to see whether the students are reading the information carefully and paying attention to detail and making sure they can then incorporate all the information in the question into their workings. Calculate the payback period. Okay, so our payback calculations are, so you know your layout for payback calculations is you write down the annual cash flows on the left-hand side. So here, year 7 must include that 500,000. And then on the right-hand side, we work out that cumulative cash flow. I'm just trying to see, they had the year 2.6. In this particular memo, they had, this is a mistake in the memo. You can see I've adjusted it. The 2.6 minus the 5,000 had to go in there. So cumulative, so you work out your cumulative cash flow, in other words, 12,000 out, then we reduce our outflow by all the inflows as they go down. For payback, you only need to calculate the cumulative cash flow down as far as when you've got your first positive cash flow, because this is the part that we need to calculate payback. We need 1 year negative and 1 year positive. And then remember, our calculation is we take the last year where it was negative, 5 years. So our payback will be 5 years plus 900 over 3120. 5 years plus 900 over 3120. So the last negative amount over the next total cash flow equals 5.28 years. And take note, that's not 5.28 months. We've calculated a percentage of a year, 900 over 3120. So it's 5.28 years. If you wanted to express it as months, you would take 0.28 times 12 months, and then that would be however many months it was. Now you've got to compare your answer to our target payback of 5.5 years. And remember, they said calculate the payback. So that's part 1 of the answer. Then it said make a decision as to whether they should or shouldn't do it. So we're going to accept the project because the payback period is shorter than the target. In other words, the project is going to reach payback before we reach our target of 5.5 years. And they asked for a reason which is the fact that the 5.28 is less than the 5.5 years. Okay, so here's our calculation, 5.28 years, the answer. Here's our decision, accept the project, and here's our reason that the payback period is shorter than the target period. Okay. Then the second part said, calculate the internal rate of return of the project. So remember, in the info that they gave us over here, they haven't given us any cost of capital or anything over here. But over here, at the bottom, they've got the information hidden away over here. It said Walt Limited has got a cost of capital of 8%. And I don't know if that's deliberate to put it at the bottom again, just to test to see that the students are reading everything. But this you would have highlighted in a nice, great, big, fat stroke of your highlighter to make sure that you know the company's cost of capital, REWACC, is 8%. So they wanted financial calculator method. So all you have to do then is write down what you would enter into your financial calculator. So remember, with the financial calculators, always the present values are always must be negative. So you've got to have one, sorry, not that it must be negative, the initial cash outflow is negative. So you would, that 12 million, you have to indicate that you would enter that as a negative figure, or you could put brackets around it. And then each of the cash flows for each of the years would then be entered into the calculator. And here at the end, don't forget that 500,000 that they told you was not included in the cash flows. You had to include it in your cash flows. So you had 2.6 million cash flow in, minus an additional 500,000 cash flow out in year 7, giving a net cash flow in of 2.1 in that last year. So all of the cash flows, and then second function, CFI comp, and then you press the interest button, and it will then solve for the value of R, giving you 7.67 as the internal rate of return. So that's the calculation, and then it asked for a decision, which is don't accept the project. There's 1 mark. And the reason, because the internal rate of return of the project is less than the cost of capital. So the project is going to cost us interest of 8%, and we are only going to get a return of 7.67%. So no, we're not going to accept that project. Okay. So you can see here how the marks have been allocated, and you can also see that the marks are allocated exactly as they've asked you the question. So even if you got your answer right, if you don't present all parts of the answer as they've asked them, then you stand to lose out on marks. And then the last part was the theory question about you've presented your findings at the board of directors, suggested that the company should always base their financial decisions on the payback calculation and not the internal rate of return, one of the directors. So give reasons why the director may have come to that decision. Why is he saying that? Why might directors prefer payback compared to internal rate of return? So remember, in this section of your textbook, your theory questions, your learning objectives, you've got those disadvantages and advantages of each of the methods, payback and internal rate of return, etc. So that's what they're expecting you to apply to answer these questions. So why would they prefer payback? Okay, because number one, payback is widely used because it's got a simplicity in calculation and understanding. It also gives us some idea of the investment's potential risk exposure, because it's telling us how long, how many years it's going to take before we actually start getting a return on our project. The higher the payback period, the longer it will take to. Anyway, so you can go through all of this, so you can see how they've given a mark for each fact. So you have to give a separate statement to get each one of those separate 5 marks. You can't just keep regurgitating the same fact in using different grammar, okay? So you had to give some comments on payback. So those 3 comments, those 4 comments all refer to payback and why we might prefer payback. And then, in other words, the advantages of payback period. And then over here, you must list disadvantages of the IRR. Because the reason that someone would prefer the payback period is because they are looking at the advantages of the payback period and they are looking at the disadvantages of the IRR. They could have asked the question the other way around and said, why would they prefer the IRR method to payback? In that case, you would have listed the advantages of the IRR method and the disadvantages of payback. You understand how this is a good question because it's really testing that you know your theory and that you can apply it properly to a question. Okay. We're going to take a short break here because we've come to, where am I? I think I've got to stop sharing this to go back here. Okay, so I'm going to